accession to the CPTPP because the rest of the world saw what went on in relation to trying to depart from international law on Northern Ireland. So I think Windsor is very good. It's the basis for a better relationship between the EU and the UK. It's certainly extremely good from a Northern Ireland perspective, but what really matters is what attitude the British government is going to take, where it wants to pitch and situate its relationship with the European Union as we go forward. I think that's going to be crucial.
Let's talk about the regulations or the diverging regulatory landscape. I mean, how do you handle this, Michael?
With great difficulty and with some complexity. I mean, for us to fly now from UK airport to non-EU destinations like Morocco, Turkey, we've had to set up a Ryanair UK airline, UK AOC, none of which is really necessary. It adds nothing, but it's another layer of regulation, bringing people in. And there is a huge infrastructure, there's huge inflexibilities now in the UK labour market. We're hiring cabin crew who we pay between 30 and 40,000 sterling a year. And there's not enough people in the UK to take up those jobs. It's not just us, EasyJet, the other Jet2, those other airlines.
Is there something that the UK government could do to...
But there is. We've had a number of meetings with the Department of Transport, the Aviation Minister, Baroness Varzi, who's not the brightest sandwich in the picnic basket, asking them to reduce...
That was a technical term, I
It's a technical term. She's had a very distinguished career running girls' schools, but aviation is really not her forte. And the industry has come up with some very specific asks. One, can we have more flexibility in hiring people, not just for the airlines, but at airports, bring people in, reduce the ludicrous cost of these visas from, say, 3,000. She would tell you, oh, this is the cost the Home Office imposes. Well, you're profiteering on the back of this thing. If you want to have a visa, we do all the work, but reduce the cost of the visas to £500 or £1,000, but there's no justification for £3,000. She's promised to look at it, but it will be 2.5 years. She'll still be looking at it in 2 years' time. There'll be no action. And the problem we find all the time in dealing with the government, despite the fact that there's been changes at the top in the UK, there is this obsession with finding, in most government departments, finding excuses or show us somewhere where Brexit has benefited. Brexit benefits. I mean, they don't want to know about the Brexit. And to be fair, we're one of the few industries that can, I think the only industry that can point to a Brexit benefit. Duty-free is back on flights to and from Europe. About the only upside we can find to Brexit. You can
There's
now
always
buy
a silver lining somewhere.
You can buy booze and fags again. But we would happily forgo the sale of booze and fags if you could get a sensible trade deal between the UK and the European Union.
Christine, do you use duty-free or... but what for you in finance, I mean, how hard is it to find people in London, and more important, how difficult is it to find traders all over Europe? I mean, what's your experience?
Yeah, look, we're not having trouble finding new people in the UK, but what I think is interesting is we're seeing actually a bit of a diaspora. So when we are needing to have people come back into Europe, first of all, people are sort of choosing their nationality. So if they're Italian, they want to go back to Italy. If they're Greek, they want to go back to Greece, etc. And so rather than going from sort of a one location in the UK, we're going to many locations on the continent, and that is fragmenting the industry a little bit. I think it will eventually land in a couple different locations. I mean, Ireland will be definitely a beneficiary of that. We continue to grow here. But we are needing to have, trading capabilities move into Europe. A lot of that is landing in Paris so far, but my call would be that it's probably going to land in a couple different locations, not just Paris over time.
Declan, your view?
Well, Ireland did not first develop the promotion of foreign inward direct investment with Brexit. There's been a long policy, very successful and well-oiled policy. The IDA have punched above their weight on this in a very substantial way. And the jobs coming in do not, in my view, compensate for the fact of Brexit. It is unfortunate that the UK, which was like-minded on business, on trade, on a whole load of regulatory issues, has left the European Union. It's altered the balances a little bit within the EU. But having said that, I think Ireland is right to make the best of it. And I agree that because we are English-speaking, although lots of other EU member states now are English-speaking, we have a pro-business approach. We have a good relationship both with Brussels and with the US. And we've intensified our relationship with other EU member states since Brexit. We've opened more offices in France and Germany in particular. Ireland has been active and agile in gearing to make the most of a bad job, and Brexit's a bad job, by making Ireland more attractive for inward investment and by also looking at our alliances within the European Union. I mentioned just a moment ago that the UK used to be the big member state that had a kind of liberal approach to trade, pro-business. The UK have gone, and in the world of qualified majority voting in the EU, it was important for Ireland to recalibrate. So we have, in a sense, become more North European since the British have left. We have economic similarities with a number of the Nordics, the Dutch, the Baltic states. So we've repositioned ourselves. And I think that process of being agile and constant repositioning is an important element of how we continue to do, I hope, do well in the European Union.
Christine, coming back to London, I mean, when all is said and done, how big or how small is City going to be in the city, and how big are you going to be in the rest of Europe?
So look, I mean, I'll just put it into some perspective already. So we've got 15,000 people in Europe, and we've got roughly 8 in the UK. But interestingly, the UK has been growing, despite, the sort of rebalancing.
Why is that?
I think it's growing because we continue to have that as our EMEA hub, but also we do continue to find really good talent in London. And so I think London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Michael, have you shifted workers?
Not particularly. I mean, we tend to be more opportunistic. So, we allocate our growth to those airports who need it most. There's been huge growth opportunities in our business post-COVID. We've seen a dramatic downshift in aircraft capacity across Europe. Airlines like Thomas Cook have gone bust. Alitalia has only come back 50% the size it was pre-COVID. TAP is only 60% the size it was pre-COVID. So we tend to allocate. We're taking 50 new aircraft from Boeing in advance of the summer. That's that they can actually deliver them. But we are distributing those all across Europe. We are still growing in the UK. I mean, one of the interesting things, I think, with the demise of Thomas Cook, cutbacks in the liquidation of Flybe, there have been opportunities at UK airports. So we're growing. We've opened up a new base in Belfast this summer. We're expanding in Bristol, in Birmingham. We're still growing in Stansted. We've been greeted with enormous demand from UK people, passengers and their families going to the beaches of Europe on summer holidays. I think people have been locked up for 2 or 3 years during COVID. I'm surprised at the strength of spending in the European economy at the moment, for all of the talk of fuel poverty and consumer price inflation. There is full employment and people are getting paid at the end of every month, and they are spending, and certainly they're spending on travel. Which means, unfortunately, in our industry, the next crisis is probably about 2 days away. But nevertheless, business is booming and getting boomier.
Always look at the bright side of life. Right?
Except for the airline industry.
We didn't actually comment on the poll at all. The first one, where about 90% of you agreed that it was either as messy or messier than people expected. We'll have a second poll now, and also a question to you. It's more the long-term view. It's interesting that you both say that you keep growing in the UK despite all the difficulties. And so the question is, and please again, audience, do vote. Long-term, will Britain be better off, or about the same, or worse off with the Brexit? Somebody was very quick and negative there. But anyway, let's take a 20-year view. If we're all alive, then where do you think we'll be in terms of Britain and Europe? Declan?
I'm reminded of what probably the most distinguished US Secretary of State of the 20th century, Dean Acheson, said he was working for John F. Kennedy as an advisor back in 1962 at a commencement ceremony at West Point, where he said, Great Britain has lost an empire but not yet found a role. And this caused a huge stink. The Macmillan government wanted to throw out the American ambassador, recall the British ambassador. But nobody paid attention to the next sentence of what Acheson said was, but the solution to this is by joining the European Economic Community. So I think if you look at it in the long perspective, you can wonder why the UK did this so counter to their interests. If you look at the drop in growth, the problems in productivity, the drop in basically household wealth in the UK, you could also wonder why they did it now at a time of geopolitical turmoil that hasn't been seen for 50 years, in which, if you're on your own, you're a cork bobbing on the edge of a whirlpool. And you have to ask, where will the UK go on this? Now, there's talk about the UK rejoining the European Union. I think that raises very many questions. I don't think that's going to happen in the short term. And remember, the UK, when it left the Union, had a whole series of special deals. Agricultural budget rebate, opt-outs on monetary union, opt-outs on justice and home affairs, and other things. And those will not be granted if there is a rejoin. But the final point, and I think this kind of goes to the heart of your question, there's a problem, and this is from my experience dealing with Brexit as Irish permanent representative. There's a problem with both the Brexiteers and the Remainers. They tend to misjudge what's required to have a close relationship with the EU. I mean, look at Switzerland. I mean, the Sunak government said, let's do what the Swiss are doing. The Swiss, first of all, apply full freedom of movement. Secondly, pay into the EU budget. And third, accept dynamic EU regulation, over which they have no say. I simply don't see the UK public opinion in the short term going down that road. So in some, it's bad for the UK. It'll continue to be bad for the UK. They will readjust. They're joining CPTPP. They're joining other trade deals, all of which, or most of which, are replications of what the EU has already done with those third countries. But there's going to be a problem down the road of how you manage that fundamental contradiction in opinion in Britain, wanting to be close to the EU, but not wanting to do what's necessary, what the European Union calls the balance of rights and obligations.
Christine, are you with the majority here, or 84% of you think negative?
Look, I tend to agree with Declan. I think its role in financial services will have to be reshaped, and it had the benefit of having the entire European continent operating its financial services industry from London. That is a major change, and I think that is a net negative for the city. And I do think that Europe will have a net positive over time, but I do also think that Europe has some work to do. You know, we still have to improve the banking union, the capital markets union. We need to create an internal market that is actually a true internal market with free flow of capital. And that doesn't happen today. And so I think the EU also has some work to do to take full advantage of what's just changed and not land in a place where we have continued fragmentation on the continent.
Michael?
I think 20 years is too far out because there's much that the UK can do over that period of time. But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from. And I think that will happen. In the next 5 to 10 years, you will have quite a number of the Brexiteers will die because the average age of them are generally about over 70 years. And I think there's still a huge majority of the younger people in the UK coming through are much more pro-European. They miss out things like Erasmus, which is a tragedy. And they are much more pro-European in their outlook. I think it also a lot depends on how Europe responds to Brexit. Brexit should come as a real warning to the European Union. You need to focus on the things that improve people's lives, which is improving the single market, and focus less on the political bullshit that actually does nothing for citizens in Europe. I mean, I think Henry Kissinger was still right. When you want to call Europe, who do you call? Nobody knows. But there is much, and I think as Christine said, on the banking side, in our industry, we still have tiny French air traffic control unions shutting down the single market on a weekly basis at the moment. The French very cleverly use minimum service legislation to protect all the French domestic flights, and they cancel all the overflights. We keep shouting at Ursula von der Leyen, you and the European Commission, what are you doing to protect the single market? And all we're met with is silence. Why is Europe not using minimum service legislation to protect overflights? And if the French want to go on strike, which they are perfectly free to do so, let the French flights take the cancellations because they deserve them. Yeah. So I think much depends on what Europe does or how Europe responds to Brexit.
I'd like to zoom out a little bit beyond Brexit. Obviously, we're still dealing with the war in Ukraine. We also have what it means for energy supplies in Europe. We also have the worsening US-China relationship. EU-US relationship not as great as it could be. How do you navigate this as a businessman, businesswoman, Christine?
I mean, look, I think it's, when I talk about what's happened in the last couple of years, right, it has been pressure testing across every potential dimension. And I think that has required a ton of agility and a ton of ingenuity. But actually, Europe's done pretty well, and they've chosen to work quickly with various programs to get out ahead of whether it was the pandemic packages or the energy packages. And if you think about the headlines this morning about energy storage, the fact that at this point in the year we're almost at full storage, that's terrific. But that has been at huge cost and huge requirements to be agile in this environment. I think that's what we will need to continue to position ourselves around because we just don't know what's going to happen. But the good news is I think the EU in particular has shown its agility to work pretty quickly in what is otherwise could be a slow-moving animal. So it's been positive.
Michael, if you exclude the French labour unions?
I mean, I see all of these, as huge opportunities. There is no crisis that doesn't present an opportunity to your business. We've gone through 2 years of COVID where the airline industry was grounded. We went back to Boeing, negotiated more aircraft at a lower price, and as a result of that, we are expanding at a much faster rate post-COVID in Ryanair. This summer, we'll operate at about 130% of our pre-COVID volumes in a market where people are paying higher airfares for travel because of the pent-up release demand for travel. Every one of these issues creates an opportunity for your business. So the question is, how do you target those opportunities? Where's the opportunity for your business to expand, to lower costs, to capture more customers, or to offer a better service to customers? And in Ryanair, that's what we're trying to focus on all the time. So we see and try to treat each of these potential crises as one of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We will be Ukraine's biggest airline the week after they tell us it's safe to go back in there because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery. Don't clap, it only encourages me.
I mean, how quickly could it go back in? I mean, do you have people on standby, or
we go back in? We could fly back in there in about 2 weeks. It takes about 2 weeks to fill the seats. We have hired in the last, I think, 12 months. We've hired about 60 Ukrainian pilots. I think we have about 80 Ukrainian cabin crew, mainly at our Polish bases. We're actively trying to hire, and there are, again, EU issues with that because of the Ukrainian license. We need to get converted to EASA licenses. But we are actively looking at ways and creating opportunities where we can charge back into Ukraine because Ukraine will need a lot of redevelopment. The Russians will probably blow up the roads and the bridges on the way out the door. And the first way we'll move people into Ukraine will be flights. But we'll be back in there hopefully within 2 weeks after somebody tells us it's safe to fly back into Kiev, Lviv, Odessa. Kherson will be a lot longer because it's and the airport has been destroyed. I see Ukraine as a huge opportunity for European businesses, to participate and to accelerate the recovery of Ukraine post the war.
Declan, what's your view on opportunities amid all the crises?
Well, opportunity is probably the wrong word, but it's a positive thing that one of the positives that's emerged from the negatives of Brexit, the pandemic, and obviously the Russian invasion of Ukraine is that the European Union has rediscovered the importance of unity. And that is, if you look at it from the point of view of even data, that's very clear. The European Union has stuck together. It's stuck together on Brexit, to the benefit of Ireland in particular. It's stuck together on the pandemic. And it also has stuck together on Ukraine. If you look at the progressive rounds of sanctions, if you look at the fact that some important kind of crossing points have been forwarded. For example, the EU is now agreeing to supply weaponry and ammunition to Ukraine as something that would be unthinkable a few years ago. So the European Union is developing and is integrating because of these crises. And I think that fits in with Michael's point that there are resources in the EU, there are kind of political currents in the EU that are going to make it, I think, very possible for business to thrive in a post-war situation in Ukraine, because the European Union will want to rebuild Ukraine and will want to devote very substantial resources to this. Mm-hmm. So in brief, I think they're the main themes I would mention.
We're almost out of time, but Christine, what's your big message to the audience? If you run a big business in Europe, what should you do?
Well, look, I think I agree very much with what Declan just said. I think in some ways, as a result of these crises, actually Europe is much more unified, and it's also becoming a security bloc, which I think is very interesting. And so from my perspective, I am very optimistic about the future for Europe. And it will, financial services is changing, business dynamics are changing, but there are opportunities around every corner. And just as an aside on the Ukraine situation, we actually stayed in the country and we continue to operate there. So we look forward to welcoming you when you arrive.
Michael, any last thoughts?
I agree with both Christine and Declan. I would think the future, I'd be optimistic for the future. I do think Europe should treat Brexit as a challenge to it. How do we improve the single market? We need less inefficient regulation. I would personally tackle the French air traffic control unions. I want to see a reduction in environmental taxation on short-haul European air travel. At the moment, we continue to have this ludicrous system where long-haul flights to and from Europe, which account for 55% of Europe's aviation CO2 emissions, are exempt. So the richest people travelling at the highest fares are exempt. And the poor people going their families on holidays are paying all the environmental taxes. We don't argue there should be zero environmental taxes. There should be environmental taxes. But let the rich business guys travelling from China and America should be paying their fair share. So I think the challenge for the European Commission is more effective regulation. Refocus your efforts, and the Commission needs to refocus its efforts on improving the single market and making Europe, the lives of its citizenry in Europe better. And that's ultimately the way to prevent further departures like Brexit.
That's all we have time for today. Thank you very much for coming. That was great.
Thank you.
Thank you for listening.
Please welcome Peggy Johnson, Chief Executive Officer, Magic Leap, and Bloomberg's Francine Lacqua.
Hi everyone. I hope everyone's adequately hydrated and caffeinated. And Peggy, thank you so much for joining us. I mean, we're in one of the most exciting spaces.
I love
frankly,
it.
full stop. Right? Like, it's been built bigger than the internet. Before long, we'll be all leading second lives. in an immersive virtual reality known as the metaverse. So let's start with augmented reality, AR. How has that changed in the last 3 years because of COVID?
Well, COVID was a real driver for attention to augmented reality because it allows you to be physically, virtually present in a place that you can't be. And so it was a technology that people turned to during COVID because it solved a problem for them. And it's, since then, it's continued to increase in engagement, but that was a real pivoting moment for augmented reality, where before it didn't have quite the same limelight as it did until COVID.
Yeah, I feel like 2 years ago we were just talking about the metaverse, about how some of the big companies were invested in it. We were talking about some of the underlying technology, and then GPT takes over and AI. Like, what's the interplay of the two?
Well, it's interesting. There's quite a bit of interplay. Already there's a lot of artificial intelligence in augmented reality. So just a quick primer, augmented reality is you access it through a device like this. This is a Magic Leap device. You put it on, you still see your physical world, but in it is placed digital content very intelligently. So you can think of it as a tool to help physicians in the operating room, to help folks on the factory floor. With ChatGPT and really the focus on the power of artificial intelligence, you put those two together and you can think of it as two powerful tools, creating really a 1 + 1 = 3. So where now a physician can see perhaps a CAT scan in 3D volumetric form in front of their eyes with this, overlaying AI on top of that, you can draw the physician's eyes based on some volume of data that the AI has been learning, that look here, there's a possible stroke in this brain. So it'll be an extra tool that a physician can have in or out of the operating room.
I mean, that's your headset.
Yes, it is.
And then you can also, I think, see it upstairs.
Yeah.
And I mean, they're a good-looking set of glasses.
Thank you.
They're smaller than they used to be, and you really pivoted in trying to go enterprise. So is this a space that will be, freewheeling or very corporate and regulated?
So we are very, very grounded in the use cases that this technology can really bring a return on investment today. So there's a lot of focus on consumer augmented reality, but that really needs something like a pair of glasses. That's what people will wear, throughout their day, the broader consumer market. But today, enterprises can use this device to have a digital twin on a piece of, factory machinery or for training and that sort of thing, and have a return on investment. They can reduce training time. There can be better outcomes in the surgical theater. And so that's why we're staying focused there, and consumer will come over time. I always like to use the analogy to mobile phones. They started first with businesses who saw a need to make a phone call from your car. That was amazing. You didn't have to park and find a phone booth. You could make a phone call from their car. There was an ROI to buying the device then. And then it grew to where it is today, where everybody has a phone in their pocket. We're at a similar stage with augmented reality.
I mean, I feel like 5 years ago we were talking about nothing else. Are you frustrated that it was a little bit slow, or actually is it normal that it's slow as we figure it out and then it advances quite quickly?
I think what happened with augmented reality is it started, because it was so amazing, people thought, well, there must be entertainment use cases, consumer use cases. And the device at the time, because we had a previous version and others have had previous versions, they were larger, they were a bit clunky. It wasn't really a consumer device yet. And just like a mobile phone, they were big in the beginning and expensive and not tons of content. That it'll come down this trajectory to where it'll be a mass market device. It'll be at the right price point for consumers. So what was frustrating is that the entry point was focused on consumer. And when I came to Magic Leap, I pivoted to enterprise, because that seemed to me to be the right entry point with the state of the technology.
Because also the headsets are quite expensive, so it makes less of a difference, right?
Yeah.
Is price important for, you need also a lot of cash and support to make sure that the R&D goes in there and gets better.
Exactly. And price is important. So you need to bring this to a point where there's more silicon integration, for instance. Like that was why mobile phones were so big in the beginning, because there was so many parts in there. And then over time, it integrated into just a handful of chips in your mobile phone. We have a separate compute pack that is basically the power of a PC here. And then the device itself is lightweight enough where someone in the enterprise can wear it all day, but probably not a consumer walking around on the street yet.
I don't know. It's very Matrix.
It is. It's kind of cool looking.
Peggy, a very quick show of hands of who has tried AR in the last 6 months, because it's moved so much. So I have one show of hands, a couple. I mean, we maybe have 25%, right, of people. Again, how quickly do these things get better? So to understand, if you're an investor, you have to try.
Exactly.
And to understand the usage, really.
At this point, it's really about the ecosystem. So what are the solutions that can be built on this platform that are valuable, that people can see? They solve a problem, right away. And so that is the thing that has to grow, the ecosystem of solutions. That's what we're focused on from an enterprise space. So a lot of folks perhaps, like there's a company named Senti AR that we work with, and they do, on a PC screen, they'll do a volumetric image of your heart. And surgeons use that when they're putting a catheter into a heart. They'll look down at the screen while they're putting the catheter in. Well, now they've just built a solution that has the live heart in front of the surgeon's eyes. They can move the heart around. They can see the camera of their scope going in. It's a safer way to navigate. The outcomes are better. So this type of tool in the operating room, I think, is going to be game-changing. I think we'll look back and say, remember when we had operations without augmented reality, because you want the safeness and the accuracy.
A reminder to everyone, you can also send audience questions. So I have the iPad ready, so please do send them in. I think there's a QR code that you can scan. Peggy, overall, how big is that market? So when you look at appliances, for example, in healthcare, what are we talking about? Is it billions, or do you really need it to touch the metaverse to then make it very profitable?
Yeah, I feel about this market the same way I did about the mobile phone industry. So I was 25 years at Qualcomm. I'm an engineer by training, and I saw it start as a tool for enterprise and then go up that curve. I feel the exact same way about this. It is going to be game-changing. It's a computer on your eyes. Eventually, getting to glasses over time, and even there's companies dabbling with augmented reality and contact lenses. And it's an interesting world ahead, because now our heads are down looking at our phone when we want information. We can have a heads-up experience again because you're back in your real world, and we can just put the content where you need it intelligently, and you interact with the content. So it's going to be a new experience that it's going to take some time to get to the end game, but today there's actually very viable solutions.
How or when and how big do you expect the metaverse?
I think it could be as big as the mobile phone industry, because it does a lot of what we rely on our phones for now, and that's sort of the promise of where it's going. But early days, enterprise, later getting to that mass market.
Do we need to regulate the metaverse, and do we have
Absolutely.
the right people that understand it now to make sure that the regulation is not 5 years behind?
Yeah, we feel very strongly about this. Our only business is building these devices, but so we're not also trying to sell cloud or gaming or advertising. But these devices are a step above your mobile phones. They're brimming with sensors. There's several cameras that look out at your world, because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes, so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes, or the enterprise that's operating it. It goes within their corporate IT infrastructure and doesn't get offloaded without their say. So I really think that is at a very minimum needs to be in place.
And so how do you see the infrastructure ecosystem? If you look at the metaverse, is it free, like the internet, or is it a Facebook model?
So we have taken the approach where we really want to integrate, and I think this is because we're at the beginning of this technology, we have the opportunity to form things this way, but we want to be as open as possible. So whatever platform that's out there already, we're Android-based, so if they want to integrate to it, we work to help them integrate. So we've integrated to things like NVIDIA's Omniverse. They have an amazing platform that they've built. Microsoft's mixed reality toolkit. So we believe that the way to grow the ecosystem fastest is to integrate to platforms that are out there. Unity, all of the Unity applications, we can, because we're integrated to Unity, with some work, can be ported over. And so that, I think, is an approach that we can take because we don't have another business that relies on keeping it inside of a walled garden. So we really are pushing for that and want to keep it in that space, very open, very accessible.
So Peggy, when you look at what industry group it actually disrupts first, so healthcare, probably one of the most ones. I don't know whether that leads to job losses or how you think of the transition, and then what comes after.
Yeah,
healthcare?
It's interesting. A lot of folks have said, "Is this a job killer?" No, it's a tool for workers. In fact, one of the surprising things we found is we were working with several companies in the manufacturing space. Their biggest problem, they have supply chain problems and things like that. Their biggest problem is keeping workers, retaining workers, hiring workers, because the workforce in that space is aging and they're retiring, and it's been hard to refill the pipe. That's their biggest problem. This actually has been positioned as a way to bring factory workers into the same world that we are in, having a digital space around you. We have a PC on our desk. Well, a factory worker doesn't always have access to that kind of data. Now, this is a PC on a factory worker's eyes, and it helps them do their job better, more efficiently, faster. They have more cycles to do other things if they can do their everyday work through a workflow process that it can guide them through faster. They can be trained faster. Training costs come down. So it's been more of a tool for retaining, which was kind of surprising to us. You can reduce training costs. We've got great stats from companies reducing training costs quite a bit.
On that, is it because you absorb information better?
Yes.
So it's just the absorption?
Exactly. And you can put them out on the factory floor faster. So for instance, if you were to be trained on maintaining and repairing machinery on a factory floor, that's your job. You might sit in a classroom for 3 weeks and you go through books and presentations, and then that machine doesn't break for 6 months, and then now what do? I can't remember exactly what I learned 6 months ago. This device, you can replay what you've learned. You can put a digital twin over the piece of machinery that's gone offline. It can guide you through the first step, the second step, the third step. You can call in an expert who may be a continent away, because many times the actual experts on these machines, there's only a handful, and you have to fly them in. Now you can call them in. They can see what you see from any device they have and walk you through a fix or bringing the machine back online. So that's going to be a game changer as well.
So, this may be a dumb question, but actually if you're a chief executive, you probably need to know this. Do you need someone, then every time you train someone on that machine, do you program it? So do you need an AR specialist that works for you so that if you buy the headsets, it gets reprogrammed every time?
You know, the headset, because it has an open developing platform,
yeah.
it's actually quite easy to program. And so we're focused on taking a lot of existing apps that, as I said, maybe are portraying something in 3D on your 2D PC and helping them port that over so they can take advantage of the 3D visualization. But yeah, but cognitively, when you can see something in front of your eyes digitally, there's a higher ability to retain that than, say, looking through a book or looking at a flat screen.
I imagine user experience is just also getting better and better. At the moment, what's the barrier to really roll that out?
You know, probably the biggest barrier is just continuing to grow the ecosystem. And first of all, also just educating on what AR is, how it's different from VR. So VR, you're fully occluded, you're in a virtual world. You can't move around much because you won't see the coffee table in front of you. So AR is very different. And so we spend a fair amount of time just on the education of that. But then it's really going to be about the content and growing the content.
If you look at a template for the metaverse, whose vision of the metaverse will finally take place? Are you know, how difficult is it to even find out now where we'll be in 5 years?
Yeah, it's interesting. I think what you hear a lot about is VR. Obviously, Facebook has a big presence in the VR world, so you hear a lot about VR. But I really think of VR, virtual reality, as a subset of what AR is and then can be in the future. And so I think that gets missed sometimes because people think, oh, okay, you know, I don't know if I want to live in this other world, put this headset on, be in another world, maybe for entertaining purposes, if that's a lot of fun. But AR is really the bigger world because now you have a heads-up view of your world again. Hopefully our phones just merge into these AR devices and we're looking at people again rather than looking down at our phones and devices.
5 years, 10 years from now? When's the...
I think by 5 years we'll see the first consumer products out there. And it'll be like the mobile phone. They'll get smaller, lighter, faster, more battery, more powerful over time. And
you're definitely a leader in this space, so you probably have a sophisticated shareholder base or people that come to you. But do investors understand what's the most common mistake investors actually make when talking to you?
Yeah, that's a great question. I think they think, well, it's too early for consumer, so I'm not going to invest yet. It's not too early for enterprise. There's viable use cases now. This can solve problems for people in the enterprise space and public safety and in training and 3D visualization and healthcare and all that. And so it's a little bit of an education that, because there was quite a bit of a hype cycle, and we're trying to ground people back to what it can do today.
Do you feel like you're competing with funds because of everything around AI and ChatGPT and the likes?
We try to really tell people how the two go together. And so right now these devices are capable of using quite a bit of AI through what's called computer vision. So that's when a camera looks at something and it doesn't just take a picture of it, but it knows what it is. So there's a chair in front of me, takes a picture of it, and then it recognizes that's a chair. That is a type of artificial intelligence that we use every day in these devices. And then it'll just get better from there.
I get often the question of, investors or people, chief executives say, I want to get smarter in the space, but it's moving so fast. I don't know what to read, or I don't know who to listen to. Do you have, if not a mentor, a book that you go back to, or again, the pace of change?
Yeah, the pace of change has been
quite incredible,
phenomenally fast. I think the best way to keep up with it is just articles and things. I can't even point to a book that would be fresh and would have kept up with even what's happened in the last 12 months or so in this space. So just articles. There's a lot of media outlets who have daily AR newsletters, and that's a great way to keep up with the space.
And you're in such a fast-moving environment because of the nature of what you do. What's the best piece of advice you've ever been given about how to decipher this world?
For me, the best piece of advice is to stay grounded and not get caught in a hype cycle. Really, I've been in the industry for so long, so many things have ridden that hype cycle, and it's all about what can the technology really do right now. And so we try to stay very, very grounded.
Peggy, thank you so much for a great conversation.
Thanks, Francine. Thanks for having me.
Welcome Elaine Coughlin, co-founder and managing partner, Atlantic Bridge; Elodie Dupuis, founder and managing partner, Full In Partners; Stephanie Galantine Heller, managing partner and co-founder, Bootstrap Europe; and Bloomberg's Aggie Cantrill.
So we're going to be talking about SVB today, but I thought a great way to start is essentially looking at how raising equity has become much more challenging over the last half year to year for a lot of the growth companies, not just out of Europe, but also out of the US. And so raising equity was getting harder since the middle of last year. And then in March, SVB's collapse sent shockwaves through the industry. And the question that I want to start the panel with is, as we're seeing the challenges, the core challenges that are being born out of an end to negative interest rates and what that means for this sector, is the party over for venture capital? And if you want to start, Stephanie.
Well, is the party over? Probably not, but it's true that last quarter funding of European startups have decreased by 12%. And that's a further 12% on top of already very depleted 2022 in terms of capital raising. And so it's true, it is very challenging right now for a startup to be able to raise money, and you add the SVB collapse on top of it. So really it's about the access to capital. So when some of the funds, and we're part of it, that have raised during despite, let's say, the crisis, are well placed to come and help the venture industry. But it's true that it is challenging.
And coming from the VC side, Elodie, I wanted to ask you as well. Elodie, unfortunately, can't be with us in person here today because of flight cancellations. But I wanted to ask you as well, when it comes to the context of what that means for VCs, how is it going forward where you're going to be allocating funds? Is there a change in the sort of sectors that you're looking at because of this?
So I grew up at a time that was in 2008, right, when the U.S. was actually entering a recession, right? So we had a very strong focus at the time on fundamentals in businesses, meaning companies that were either profitable or had a path to showing profitability. What I saw in the last decade, maybe in the last 5 years particularly, was sort of an abandonment of that focus as companies were chasing sort of hyper growth for extended periods of time. What I think the collapse of SVB means is a lot of investors are going back to those fundamentals and looking probably with higher scrutiny today than they were over the last few years for businesses that actually have demonstrable proof of a profitable revenue plan and profitable growth. So that's a shift in focus that's happening more broadly in the industry. There have always been certain groups that have had that as part of their investment philosophy, but I think that's becoming more the norm. And the second component I'll add is there were a lot of entrants in the market in the last 5 years of groups that had either been very successful founders and suddenly found themselves with a large liquidity event and capital where they wanted to get involved in investing out of a personal passion. I think you're going to see a reversion to more professional, institutionalized investors who have a framework, who have a more repeatable investment strategy that are actually going to continue to be active in the market. And some of these other profiles of investors that have been sort of popping up and prevalent over the last 5 years are likely going to fade away as they ride out sort of this downturn in tech funding.
And Elaine, do you think that that essentially means that this sector is going to be maturing over the next couple of years after this negative rate environment is no longer the case?
Well, I think negative interest rates have obviously meant there was a lot of loose money chasing, in some cases, speculative companies and proposals. There's a much more revision now back to the fundamentals, as Alan was saying there. You know, in Ireland here, we have one of the highest ratios of VC per GDP per capita in the world, where we'd be ranked in the top 5. We have a very strong pipeline of innovative companies, and I think the types of companies now, so the noise has gone out of the market. It has been tough, by the way, for the last 12 months, I'd say, for innovative companies, and it's just got tougher with the Silicon Valley Bank situation. But what we are seeing is companies with really deep, defensible, strong IP, fundamentally sound business models, great entrepreneurs, great management teams, are continuing to be able to raise equity and debt. So I think that's a really positive sign. But I wouldn't sugarcoat that the environment is definitely tough. We see that in the numbers that you mentioned, Stephanie, and it's the same in Ireland. Our last quarter numbers were significantly off, even though year on year we were flat, about $1.5 billion, 22 on 21. The last quarter was substantially off by about 60-70%. So that's going to feed through. Remember, these businesses are long term. We're investing for 5-year plus. So they tend not to be as impacted by, the interest rates today. And the types of sectors I would be very optimistic about. We've seen what's happened in the launch of generative AI, and that's going to have a massive impact on enterprise. That's just the consumer side of it. All businesses have to digitize. There's huge competition globally now, so the efficiencies you need from digitization. And then you get into things like semiconductors and quantum compute and cyber and medtech and precision medicine. So I think we're going to see, out of all of the funding that has happened, the funding cycle now in the future, we're going to see transformational companies, global champions emerge from that. But all of the noise and the Me Too's and the less fundamental, without a competitive advantage companies are going to find it really difficult and probably won't make it.
But when we talk about the noise, something that's interesting to look at in the sense of the technology that's really going to bring a lot of companies forward and a lot of businesses that potentially want to invest from outside these sectors. I think a fair question is also, is VC the only channel for these sort of companies? Because when I speak to people who work, for instance, in the deep tech sector, they say that often because they're looking at development that takes a lot longer than the average cycle for a VC, that maybe VCs are not always the best option for them, and maybe they're looking at forms of government funding or from corporates also looking to invest in startups as well. I would love to hear what you have to say about that. If we start with Elodie, perhaps.
Sure. I mean, we've seen a rise in corporate investing over the last, again, 7 to 10 years or so. And I think that's an excellent use case, right, of where it makes sense to have a longer-term horizon. There are also a lot of innovative fund structures coming out, so evergreen type of funds. Sequoia sort of pioneered a continuation fund so that they're able to remain in their businesses much longer. There are also certain groups that have always been designed to be longer hold periods, so multifamily offices where it's patient capital to begin with, and there's not necessarily the same type of pressure to return on an IRR basis. So I do think that those alternatives have existed for a while, and in the ease of raising capital from VC that we've seen, especially in the last 3 years, where I think that we all acknowledge now that it was sort of the top of a bubble, that maybe have sort of kind of fallen by the wayside and wasn't the core focus for a lot of groups. But as those funding drivers start to dry up, I think it does create path and opportunity for other profiles of investors. So I do expect that you will see that. I do think, though, that use case is going to be fairly limited to specific types of businesses or specific industries. And so for a vast majority of folks that are playing in traditional software consumer traditional software and consumer businesses, you're still going to see a healthy amount of deal activity from VCs. It's just going to get concentrated back into a more professional landscape of an investor versus what we'd seen in the last few years.
Stephanie?
Well, you saw the announcement this morning of the 43 billion war chest by the European Union for semiconductors. So obviously it's true in terms of all the strategic sectors. In terms of innovation, you will see government step in and try to push innovation. I think what you see also with the generative AI that you mentioned is over just this quarter, they receive about 11 billion of financing in the first quarter of 2023. So if you look at generative AI, it makes every business more capital efficient. You need to recruit maybe less people. It doesn't mean that you don't need. We are not going to create new jobs that are different than the one we know today. But clearly, the progress in bioinformatics also makes some of the life science businesses less capital intensive. So it's possible that some of the companies also see their costs decrease and maybe won't need as much capital as they need today. So you can also imagine a different world where innovation is so fast that you don't need as long to develop it. With the compounding effect of innovation in generative AI, every week it's so fast that 1 year in that area corresponds to 12 years of development of the world we've known in innovation before. So we might be in this world where everything is accelerating. And in this case, for us as venture lenders, it probably means we also need to reinvent how we allocate funds to the startups.
I think it's probably a fantastic opportunity for the CEOs and the companies in the room, the market today. It's almost you have to put the head over the heart, though, because I think obviously in a world where we've inflation and rising interest rates, and you're trying to keep and maybe some softening in consumer demand, and you're trying to keep budgets, everybody's focused on burn and costs, that it's hard to invest also. But actually, that's the right thing to do in terms of some of these transformational industries, in terms of how they affect your businesses. And it's actually the best opportunity because we're no longer at peak. So what you typically see in these cycles, and I've been through too many of them at this stage, 2 or 3 of them, is the corporates leave the market. The CVCs leave. And I understand why, because of the issue that I just said, the focus on, let's all hands on deck. It's actually counterintuitive is what we have to do and continue to invest. And now the markets are at prices, and the companies that you possibly, regardless even of price, that you couldn't have maybe get into, you now can, and it's an opportunity to try before you buy. And I think it's also an opportunity for M&A for a lot of corporates into some of these competencies that your business doesn't have. So it's a great opportunity to get talent, to get tech that is relevant to your business. So I would say that's a great opportunity. And VCs, we're a VC, but it's only part of it. We partner with corporates. I think government is really important here in Ireland. The IDA and Enterprise Ireland run the Disruptive Technology Fund, and that's all around funding corporates along with the indigenous Irish companies together to do joint R&D and to do programmes. So the Irish government will actually help fund a lot of that kind of transformational technology with a view to getting that out to the market. And I think so. You mentioned the CHIPS Act, the European. If you count up everything Europe has done in the last 18 months, there's 1.5 trillion of government investing going into these strategic autonomous sectors of semiconductors, cyber, supply chain, manufacturing, digitisation, green, climate, sustainability. And we're doing the same here in Ireland, and I know in Britain with the Future Fund Breakthrough, and the French and the Germans. So I think for corporate, it's a huge opportunity to partner with government and with VC and private investors and debt. It's going to take the combination of all of this to fund the rollout of these deeper technology, fundamental technologies, and I think the corporates have to have an exposure to that as well.
And also, we were just talking about this backstage as well. When we're looking at corporates and their role in a startup ecosystem, there's also a question about these companies being quite green, quite new, and also being able to make sure that these companies can navigate times like, for instance, the downturn that they're currently seeing. And going back to SVB, I think that this is a really crucial point. There was a recent study that came out about the social media risks that SVB was exposed to, essentially because so many people in the startup ecosystem all have the same connections via LinkedIn, via Twitter, and that the concerns from within the industry were so quickly spoken out loud on Twitter, for instance, that became an ongoing risk. And I would like to know from all three of you, essentially, what that means going forward. When you're talking to the companies that you work with, are you more clear with them about what they should really be thinking about when it comes to how they communicate their own concerns? And is that something that's a risk, you think, to potentially other fintechs that could see a similar flight of capital like we saw with SVB?
Do you want to take that? I think the speed at how Silicon Valley Bank happened is still reverberating and still a shock to us. And, you know, the fundamentals of their business model was not what took them down. It was a treasury rate risk mismanagement. And what we have found, I suppose, from that, and as you said, the social media aspect, which kicked it all off. And, you know, if that can happen to a 90 billion bank, it can happen, you know, to any business. So I think we have not yet worked out from a regulatory point of view what is the right response to defend against this, because that bank was taken down. It could have taken down the entire innovation ecosystem. It certainly would have been a massive existential hit to it in the US, but also in Europe. I mean, we had 35 companies, Irish companies and European companies, that were exposed to that in, you know, when it was almost too late to do anything. So I think if you're a fintech or you're a consumer-facing financing business, you know, there's that risk is still out there, and we saw it move from one bank, you know, kind of leapfrog from one bank. I think that eventually the regulators were able to put a firewall in terms of the response, but, you know, it came very close to being Armageddon. So I don't think we've yet worked out how we stop that from a social media perspective. But it would not just have had, it was not contained, and I guess what we have learned quickly enough, and we've learned that too big to fail, you know, is the same as, you know, too small to fail. You know, that doesn't exist either. You can't, you know, we can't have these. It's also interconnected, and of course the confidence hit is still reverberating. So investment is a confidence business, and I would say that both the equity and the debt side of the house has taken another big hit as a result of that.
And going to that issue of a lot of this also precipitated out of the US originally and then fed into Europe over the course of a 24-hour period or a bit longer. And so I'd love to hear what you have to say on that front, Elodie, from the US, how that played out and why you think there wasn't more reticence on the part of people to push their concerns so openly and publicly on social media.
So I think the other component of what drove the SVB collapse is actually concentration, right? So when you're investing, one of the key things that you want to do is diversify your risk. And SVB actually went the opposite direction and concentrated into the tech ecosystem and the startup ecosystem, which was fantastic when that ecosystem was in the middle of the longest bull run in, I think, history in the US. And so they benefited from that for a very long time. The flip side to that is that when you are intricately connected to one sort of self-sustaining system where you've got the VCs that are backing companies and the companies that are taking debt from SVB, and SVB is underwriting based on the VCs that are in the company and, you know, the financial profile of the company, that all starts to get very interconnected. And if one of those things starts to unravel, it will pull down the entire system. So I do think that SVB was particularly unique in their level of concentration in technology. I think the other component of what we're learning from all of this is it's tough to have the right framework for underwriting high-growth software businesses. And this is probably far too much detail for this type of event, but generally, you know, as software shifted from a license maintenance model 15 years ago into cloud, the fact that it's now cloud and the fact that it's now sold on a subscription basis, that means that it's really hard to generate an EBITDA positive business, because as you're growing very quickly, you're signing 12-month contracts, but you're only recognizing 1/12 of that revenue up front. And so you'd have a natural phenomenon where you've got loads of companies that are actually phenomenal businesses with very strong economics, but they don't show EBITDA positive behavior. And so I think SVB was trying to figure out how do you actually underwrite to that profile and extend the debt, because there's money to be made for the bank and for those who are investing in those types of companies. And for a long time, I think the proxy was, are they funded by other investors? And does that give us a level of security? And I think that's the part that sort of fell apart on SVB. And it was certainly, to your point, aggravated by the fact that folks were very rapid fire discussing, not just on social media. I'm part of a New York VC WhatsApp, and there were like 1,000 messages a second around everyone sharing like rumors that they were hearing and what they thought was going to happen next, and it does create a sense of more panic. The other component to this is actually, I think, on the shoulders of investors and helping their companies with treasury management. So we were fortunate. Most of our businesses had accounts across multiple different banks. Once we saw what was coming, we were able to get in front of a lot of our companies and have them sort of load balance their capital across all these different accounts. But I think that treasury management is something that just hasn't been, again, a core focus for a lot of earlier investors. It just hasn't been something that needed to be a focus, and so I think you'll start to see private sector react faster on some of these components versus the broader sector, regulatory-wise. And then in terms of how that impacts Europe, so we were slightly different. Our European companies didn't have a lot of exposure at all to SVB. I think anytime you see an impact in the U.S., especially in something that's as sort of leading as technology, where the U.S. has been the pinnacle of tech and innovation, it does have a tendency to filter over into the European sector. And we've seen that just in our own pipeline. Historically, we've had 50+% of interesting opportunities coming out of Europe. And in the last probably quarter or so, it's been much lower than that. And I think that that's part of what we're seeing is that shift in confidence. But I think that's pretty temporary and should come back, in the next quarter or so. We tend to see it swinging back and forth. So I think we'll see that sort of normalize. But I don't expect the SVB impact to be much deeper than that in Europe, outside of everyone being a lot more aware of treasury management and having that as part of, the infrastructure that they bring to the companies that they're investing in and working with.
And just to wrap up, I wanted to also talk briefly about the prospect of venture debt and what that plays for the industry now that SVB, a big venture debt provider, has left the market. And speaking from the context of a venture debt provider in Europe, do you see SVB's departure as a potential opportunity, or do you see a downside from losing this big player?
SVB departure, they're not totally departed. HSBC obviously is stepping in. But I think what happened, you have a question, is it okay to give your deposit to a bank that, then will just lend you against, the same money that you deposited, right? And I think then you see that for the more entrepreneurial venture lenders like Bootstrap Europe, we don't have that issue because we have a standard LPGP structure. So when we lend, we don't ask for that money to come back on as a deposit. And I think for us, when you look at the numbers for Silicon Valley Bank, just in the UK alone, they were underwriting about 500 to 700 million a year. So it leaves a huge gap that we can feel. And I think it is an opportunity to also reinvent a little bit, the relationship with the VCs, etc.
And just as a final point from your perspective in Europe, what does the prospect of venture debt come in? What does that mean essentially for VCs looking to try and find runway for a lot of companies that are at the moment really struggling to find equity? Is venture debt just another option that they can tap?
I think it'll be hard for the companies to tap into the venture debt unless they've really strong syndicates equity. So equity is more important than ever now, because it'll be those companies that can secure equity will secure debt. They won't get the debt on their own. And then the other really important role is government. And I think we're very lucky here in Ireland with very active agencies like IDA and Enterprise Ireland who actively invest off their balance sheets as well and come in. And we're seeing that actually across Europe. So I'm actually very positive from a European perspective what we're going to see come out of Europe, because you have that very strong government sovereign autonomy desire to own and invest, make sure this capability is here in Europe and these companies make it through.
Great. Thank you so much to all our panelists. Thank you also for dialing in. And yes, I hope you all enjoy the rest of the conference.
Folks, before you leave the room, I also want to say thank you to you for being an engaged audience, for participating in our polling, for supplying questions. It is lunchtime. I have a few important things to say. Number one, after this morning, I know you don't want to miss this afternoon's plenary sessions. Please be back here promptly at 2:15 p.m. For the moment, however, you get to eat. There's two options for lunch. You can go down the hallway, down the corridor, to the Seeker restaurant, where there will be a buffet lunch, or you can grab and go just outside the doors of the plenary hall right here. I do want you to be sure that you don't miss the breakout sessions. They begin at 1 p.m. just down the hall from the plenary. The sessions include the state of European trade, AI ascendant, navigating unprecedented disruption, and IDA Ireland's capital and capacity, building the green economy. So please enjoy lunch, and once again, do not fail to return by 2:15. See you then.
Thank you.